From the morning reading, the Dow falls 2.1% to 16,991, hitting the lowest closing level since October. Growth worries rattled stock markets from China to Germany and the U.S., with the Dow Industrial sliding to their lowest finish of the year. The latest catalyst to pull shares lower was the Federal Reserve, which on Wednesday released July minutes showing that the central bank officials harbored doubts about the health of the global economy. That further spooked investors who are already unnerved by the economic and financial turmoil in China and a renewed plunge in crude oil prices. All four major stock indices are now trading below the 200-day moving averages for the first time since last October. Coming on the heels of a 52-week high in the S&P, similar behavior was seen in the peaks of 87, 2000, and 2007, but with the exception of 87, stocks tended to rally in the months after this occurred, even if it was in the process of a long-term topping pattern. Some fear has entered the markets as traders are pricing near-term volatility higher than longer-term volatility. Of the 16 times this has happened in the past 5 years, only one led to losses, early August 2011. The successful occurrences tended to lead to an almost immediate rebound, with losses contained below -2% before rallying. Anything more than that will suggest a change in the market environment. The FTSE All-World Index falls below support to deepen correction. U.S. suffers more technical damage as several stock indices fall. And indeed, on the FTSE All-World Index, it's at a 7-month low. Global stock selling is intensifying. Big losses are seen in both developed and emerging markets in Asia, Europe, and the Americas. There seems little doubt at this point that global stocks have entered a downside correction. The next potential support level is the January low. Most of the recent global selling came from foreign markets. Since mid-May, when the FAW peaked, foreign stocks have lost 11% versus a much smaller drop of 3% in the S&P 500. The problem is that global stocks become more tightly correlated when they're falling. That being the case, it's just a matter of time before U.S. stocks started to fall as well, which they are now doing. As for the Dow Industrials, the New York Stock Exchange Composite Index, and the Russell 2000 Small Cap, they all fell to 6-month low, all trading well below their 200-day moving averages. The S&P Large Cap Index plunged well below its 200-day moving average, and it's doing so by the largest margin since last October. A downside violation of its July low now appears likely. All major market indices are in the red. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:28 a.m. Central Time, and I'm recording this in preparation for the market day of August the 21st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, quite a bit of content there from the morning reading. A lot going on in these markets. Let's see what the overnights have done as a continuation. We have had some continued weakness in the overnight, though not severe by any measure. We're down 4 points on the S&P futures, or about a little less than 0.25%. The Russell's essentially scratch. NASDAQ continued some weakness, down almost 0.5%, and the Dow also down about 0.33%. Crude oil down fairly significantly, about 0.2%. You have the euro up almost 1%. Bonds essentially scratch, as is gold essentially scratch. In overseas action, a great deal of ugliness. China down 4.25%, Hong Kong down about 1.5%, Japan down about 3%, Germany down about 1%, and the United Kingdom just behind Germany as a percent fall. In terms of macroeconomic reports for today, there really is only this flash manufacturing PMI, so nothing really that's likely to be a trigger to action today. You also have OPEX, the regular monthly expiration of options, so that could play into the timing of a rebound or even a continuation pattern. You may see some action kind of calm today and then maybe early next week. But obviously a great deal of technical damage has been done, and you know, the traditional technical levels and the like are likely to be largely ignored at this point if we gain some energy. And this was certainly the case yesterday. It just sliced right through every single significant day traders level yesterday. When you get that kind of energy, you just watch the momentum, you watch the VIX futures and other keys as to you know, how far it's likely to go, and for signs that it's about to abate. Well, this is about as ugly as it gets. I mean, this is a single red body yesterday from the open to the close, closing at the lows and closing below the multi-month range. So it does not get any uglier than that. In terms of where it might fall if we don't get an immediate snapback and back into the range, the most obvious thing is these set of 4 swing lows down here around 1980. So you know, if this continues to gain momentum, right now we're down, you know, we'll call it roughly 5% from the high to the low. But we could easily fall into around a correction level territory as a percentage and drop down around this 1980 level. We mentioned in the morning reading about the October lows, and one thing to keep in mind is when you have these really sharp fall-offs, they are sometimes followed, especially in recent years and especially recent months, they often are followed by really sharp snapbacks, and a lot of people had a lot of damage to their accounts as they made adjustments to being bearish just to see their more bearish trades get absolutely slaughtered last October as it snapped back within days, you know, all the way back to where it was and then kept going. So it requires very, very nimble trading around situations like this. Focus my primary suggestion is to focus around asset and capital protection and worry about making profits as a secondary when you get this kind of environment. We are really, really on the edge, and you could suggest that we're hanging over the edge, as it were, right now. And when you're hanging over the edge, it's not a time to be playing around. It's not the best time to be taking outsized kinds of speculative plays. Be very, very small until the risk is better understood. And risk is elevated, and we'll go into that more in just a moment. But how elevated, and you know, are we going to see a snapback? And the overnight doesn't suggest a snapback, but obviously it's more important to see what happens with the all participants when the cash market opens. The Russell is as ugly as it gets. It's already been, you know, for some time in a descending pattern, as has the NASDAQ, albeit from a higher level driven by that Google earnings. But then it's been fading ever since, and clearly as ugly a red candle as you can get there. And then the Dow. And let me flip over here, show the 200s. Here's the 200 moving average. You see, I mean, a wicked break of the 200 moving average on the SPX. And also note that the shorter term moving average lines, they were super, super flat and wrapped. Look at the clouds, super flat. So this is this has been a rounding top, been a topping-like pattern. The question now is this the beginning of a much larger pullback? And still don't know that yet, but you know, it certainly is starting to gather significant steam, and once these things start to gather steam, they can fall a long way very, very quickly. So, number of things that you want to be doing to be able to protect against that. And then the NASDAQ, you know, now it's right at the 200. And of course the Dow's been below the 200 for some time. So with the case of the Dow, you actually have the moving average lines on the shorter time frames. They've already been sloped down. So this is about as ugly as it gets from that respect. In terms of market condition, as you would expect, volatility has certainly spiked up, though the skew is not even at 125. So that is of some note as to you know, some sort of tell as to are we really ready to continue to crash down. But IV percentiles, you know, went way up from where they were. Now S&P is just basically in the middle of its 52-week range at a 56, though the Russell's in the upper third at a 70, the Dow's at an 84, so certainly very high there, and the NASDAQ is certainly, you know, in that upper third area as well. Other thing to take a look at here is the size of the move. We had a 2 standard deviation move in the S&P, as was with the Russell, but a 3 standard deviation move with the NASDAQ and with the Dow. And you take a look back, you know, just in the last 2 trading weeks, you've had a 3 standard deviation move and a pair of 2 standard deviation moves, as well as a pair of 1 standard deviation moves in the NASDAQ. So that is real volatility and significant price action, and opposed to some of the reports that we've had earlier in the year where we would have this kind of price action, but it largely just was, you know, snapping back and forth within the range and never really actually getting anywhere. And a good example of that would be here, where you'd have these big candles and these big moves, but they were just, you know, back to the middle of the range and stuff like that. In this case, we're starting to see real downward pressure, and the downward pressure is not being met necessarily with an opposing force bringing it back into the range. I mean, there's a lot more evidence now that is negative. In terms of our regular daily report, IBD status is still holding on to an uptrend under pressure. It's got to be holding on by the thinnest of thin. Accumulation distribution scored a D- on both the S&P and the NASDAQ. The GMI index has a technical score of 4 out of 6, but the author is in cash. That should be noted. Decisions point scoreboard, still lots of red arrows, nothing to point to hope for the bulls there. Immediate term market posture is now severely bearish. Position size opinions here, technically they're coming in at 50% and 75 to 100%, but we're going to have some nuance to that just below. In terms of the intermediate term market posture, we are indeed severely bearish with the S&P below a 50, the Dow, NASDAQ, Russell, all in that range of below 50 but above 20. You have the Dow and the Russell in danger of falling in the below 20 area, and indeed if you have another big down day, they could fall into really in quotes market crash categories for their level of bearishness. So something to keep in mind there. Also, while I'm thinking about this, you know, I remind you again about this October. It is so often been the case in recent weeks and months that just when you get to elevated levels of risk, the bulls step in, the Fed steps in, whoever, somebody steps in and drives it back up into the range. So while we are at elevated levels of risk, be aware that that is not the same as a call for a further deterioration. And indeed, this could be right at the precipice of when you see the snapback and have a swing bottom. So we have a hedge warning status increase to a level 2, which is a red light. And at a red light, you're not suggested, the opinion is to not initiate new core portfolio positions of any type, and no new swing trades, no new core put kind of positions, none of these kinds of new initiations. Really, it's about looking for evidence of a bottom, and then once you have a bottom, starting to tiptoe in, scale in, and those kinds of positions. Volatility-based elements, you notice lots of red here. Market and decline warning, sharp increase warning, VIX spike has fired off with yesterday. You also are outside the acceptable VIX trading window. We're now above an 18, and we're actually at 19. We have, with yesterday's action as well, the VIX daily squeeze fired. So it is no longer in a daily squeeze. It has fired long, and volatility has increased by more than 25% yesterday. We've been warning for some time about option income strategies needing to take into account the increasing potential of vega on your strategy selections and so forth, and that certainly occurred with yesterday's action. On the distribution day count, notice now S&P double digits at 11, and NASDAQ also came into the concern range at a 5. So, you know, this is basically saying we've had distribution days on half of the trading days in the last month. So it's about as ugly as you could see in a period. So that needs to be taken very much into account. The new high, new low on the New York Stock Exchange, 570. So as you would well expect, a very high number there on the New York Stock Exchange new high, new low index. I kind of wondered who these 64 were, and if indeed those were set early and then fell. But I did not take the time to take a look at that. Risk aversion indicators, as you would expect, all 5 solidly risk off. In terms of special opinions, we have had some changes here. Option income strategies, VIX is outside the acceptable window, so is not acceptable to initiate new option income strategies at this time. Covered call strategies, also conditions not acceptable to initiate new positions for novice traders. Aggressive traders should consider only using in-the-money strikes and or reduction in position size, and especially consider legging into the covered calls through put selling. For put selling itself, really not acceptable for new core put portfolio positions. Aggressive traders should consider reduced position size or waiting until after the bottom pattern forms and then perhaps scaling into position. So this is as conservative as it could be. In fact, these opinions would probably be largely written the same if we were in an all-out market correction, basically saying that not to initiate new positions. If you are aggressive and you do want to initiate new positions, do so through the most conservative of applications, reduce position size, legging into positions, scaling into positions, you know, all the various techniques of coming in small while risk conditions are higher. So quite a bit for today. But that should, well, I guess we could mention the sector specific. Let's drop down here. As you'd expect, a sea of red, only utilities holding up. But as I've said before, when you have severe corrections, even those that are, you know, in relative strength, stronger, are still negative. And look at this. You don't pat yourself on the back that you lost 0.5%. And so buying utilities right now doesn't necessarily get you anywhere. And while it's been one of the ones that's held up in the 1-year time frame, it certainly year to date, it has been right there with others as negative. And cash is also a position, and cash is a fine looking position when you get situations like this. So that should be enough for today. We've gone long but had a lot of information from changes both on our own opinions as well as from the morning reading content. If you find this information helpful, we greatly appreciate you retweeting us to your Twitter followers. Like us on YouTube, subscribe to us on the YouTube channel, all those various ways that you can engage through the social media platforms that we participate with. Direct feedback can be sent to support@falconglobaltraders.com. More information about how we apply these techniques can be seen at this website. And then, of course, disclaimers. The disclaimers are hit the pause button if you need more time to review them. They can be a little longer. And then, as always, greatly appreciate each of you every trading day. We'll look forward to being back here next week. Good trading.